Well, hello and welcome to India Decides, the FII View with me, Tanveer Gill. I have a very special guest joining me today on the show, Dominic Rossi, who's Global CIO Equities at Fidelity Worldwide Investment, joins me in his first interaction with an Indian business channel. Dominic, of course, joins me all the way from London. He oversees equity assets at Fidelity worth about $172 billion. Dominic, it's great to have you on the show. Thanks very much for taking out the time and speaking with us. How do you look at the India story right now? How do you tie in your market outlook on India with what is coming out on the election front? What is it that you think the market is pricing in at this point?
It does make sense that the market is looking fairly positively at this juncture. What I would say, though, and this is a further word of caution, is that often in these situations we find that markets buy on the rumour and sell on the news. As the market moves away from speculation over who would win and what would and what the government new government would look like, and move to the actual implementation. And I think at some stage over the next few weeks, the market will move from the fiction to the reality of a new government, and then start asking hard questions about the reform agenda, and that may cause some kind of a pause or sell-off in the index, which has obviously moved rapidly over the course of recent weeks.
Right, but Dominic, what about the macro situation in India? How do you read the macro story given your overall view on the market?
I think we all know the potential positives for the Indian economy and the Indian market, the consumption story, the demographic story. But I think the real obstacle to the Indian market remains the need for structural reform in a whole host of areas of the economy: the financial sector, the fiscal sector, labour markets, and the regulatory framework around infrastructure investments. And I think it's when the markets get confident about the new government's approach to those fundamental issues that we will be in a position to take this bull market to the next level. If the market gets a sense that the government may backtrack on some of those reform ideas, then I think the market will reverse.
Right, Dominic, if we take those conditions as a reality for India, that is, we get a stable government at the centre and the reforms process plays out as expected, would India be the preferred emerging market across the board?
I think that's possibly correct. I think the way that we look at the emerging markets today at FIL and how we choose between emerging markets has changed over the course of the last 2 or 3 years. Today, when we're looking at emerging markets, be it India, China, Mexico, Russia, Brazil, the first question you really have to ask is, how serious is the reform agenda? And in those countries where the reform agenda is serious, I think those equity markets will continue to progress. I put Mexico in that category. I am increasingly thinking that I'll put China in that category, and I would very much hope to be able to put India in that category as well. Countries which I most certainly can't put in that category today would be Russia and Brazil. And I think within emerging markets over the course of the next few years, or I've already seen it in truth over the course of the last couple of years, is a bifurcation of performance between those that are serious about reform and those that aren't serious about reform. Because the old model, the export-led model to growth, which worked so well during the last decade and up until about 2000 and until the financial crisis, indeed, that model of development really has passed its sell-by date, and now emerging market country after emerging market country is having to search for a new economic model, and that the premise of that new economic model is about domestic activity, domestic consumption, and in particular domestic structural reform.
Right, but Dominic, my specific question out there is, do you think that despite valuations, India will continue to draw interest from investors such as yourself compared to other emerging markets, given a favorable election outcome as well as reforms playing out as expected? Do you think that India, despite having expensive valuations, will still be a big attraction for global investors?
I think that's correct. I think that is correct. And I'll inverse your question, if I may. How do I feel about emerging market economies and markets which look particularly cheap? My view is that those are likely to prove to be value traps, because those countries are cheap for a reason. They're cheap because they're not serious about reform. And I think we will see this bifurcation in performance. I think that is already being reflected in valuations. And I think the mistake in emerging markets may be to buy the cheap ones.
Right, Dominic, I see that your India exposure stands at 6% benchmark to the MSCI at this point in time. Is this allocation under review if the election result is pretty much on expected lines?
I mean, to be honest with you, our fund managers are reviewing those exposures every single day. So I don't think our approach to managing money is likely to change, nor do we asset allocate funds to markets in the way that you might expect. My job isn't really to take billions of dollars and direct them to India versus China or vice versa. We give quite a lot of freedom to our fund managers to pursue their views. Sometimes they differ. So it's not really appropriate to focus on a certain level, 6%. Will it go to 8% or 9%, or will it go back to 4%? But certainly today's developments and the fact that it looks like we do have a government with a sound majority, with a position, if it chooses to drive through structural change, is one that we would view as positive for the long-term outlook for the Indian market.
Right. What about what happens on the growth front going forward? What is your expectation on that front? Because a large part of what comes out of the election results, or having a stable government at the center, is really bringing about revival in growth. So what is your expectation there?
I think that we've seen some improvement in macro fundamentals in the Indian economy over the course of the last 12 months or so. And I think that will continue. However, I still think that India is in danger of a boom-bust cycle. We've seen that over recent years, but the persistence of high fiscal deficits, low productivity, and persistently high inflation rates means that India is unlikely to enjoy a prolonged period of economic growth, sustained non-inflationary growth, without the structural reform. So it's difficult to answer your question without continuously going back for the need for that reform.
Dominic, you believed at the start of this year that there would be some sort of differentiation among emerging markets. Is that your approach still? What is your broad EM strategy at this point?
Yeah, I still think we're going to see a significant bifurcation of performance within emerging markets, and I think that theme is likely to continue for not simply this year, but for a number of years. And the real reason for that is that the growth model which emerging markets operated really from 1998 right through till after the financial crisis, that growth model based upon cheap currencies and exports on sovereign wealth funds and dollar reserves and cheap local financing, that economic model has basically run out of its track, principally because Europe and the US are improving their current account trade positions. You can't really grow as an emerging market on an export-based model if the rest of the world is running current account surpluses. So there really is a need for emerging markets to change their economic model, and that means moving away from an export-led model to more domestic-orientated model. And the trouble with the domestic model, orientated model, is it really won't get going unless you are prepared to focus on structural reform. And this is why we've given so much emphasis to the structural reform theme, and those markets which are pursuing structural reform, be it Mexico, be it China, be it now possibly India, it's those markets which will get re-rated, and that's precisely what we've seen of the Indian market over the course of the last 6 months.
Yeah, but what are you pricing into your EM strategy from a risk perspective on account of the situation in Ukraine, the downgrade in Russia, and the China slowdown?
And I think an important point there, we see the Russian market suffer, but it hasn't really had a contagious effect across the emerging market spectrum, or indeed across the world equity markets. And here again we see points of differentiation forming as investors are prepared to distinguish between what may be going on in Mexico and India and Russia. So for now at least, the Russian discount is not finding its way around the world. As for the Chinese slowdown, I think that is understandable. I think it's correct. I haven't personally been very confident that we would see Chinese recovery, and I still think growth in China will continue to disappoint. However, and importantly, that's not necessarily a bad measure for the stock market. Indeed, we had the Chinese stock market growing 10% per annum for a number of years, and the stock market went nowhere. So it doesn't seem to me logical to assume that just because growth is weakening that the market should necessarily do badly. Indeed, I would actually argue possibly the opposite. I would argue that it's because Chinese growth has been too great and unsustainable industries have been allowed to grow that returns on capital have declined, and that has suppressed the Chinese stock market. I hope the Chinese government do pursue a reform agenda. I hope, for example, they do consolidate a number of intensive industries such as the steel sector, and as those industries actually shrink, we'll see returns for shareholders actually improve. So it is possible that as the Chinese economy slows, that the stock market actually rallies.
Dominic, it's been a dramatic year for EM currencies with vast swings. What is your view on the currency market going forward? The Indian rupee, of course, being an exception with a strong rebound of 12% seen from August 2013 lows. So what's your view on the rupee as well as other emerging market currencies?
I don't think the volatility in emerging markets currencies is a good sign. I think the acceleration of volatility means that equity risk premiums overall for emerging markets are likely to rise, and therefore the weaker countries will suffer disproportionately. So that, when I think about the asset class as a whole, is actually something which gives me some cause for concern.
Dominic, also in your Outlook 2014 note, you spoke about liking pharma and IT as well as telecom names in emerging markets. Do you still like those sectors?
I do, and that's as much a statement about the whole equity market globally, not just emerging markets. I think indeed during the last bull market between 2003 and 2008, the market re-rated fixed assets and it devalued, derated intangible assets, intellectual property within financial services, technology and healthcare. And I think what we're seeing in this bull market is the exact opposite. I think human capital, intellectual property is being re-rated, and I think that intellectual property is genuinely found in frontier industries, and I would put those frontier industries squarely in the IT, healthcare and financial services areas. So I do think those areas which have performed well actually indeed have had a bit of a sell-off in the last few weeks, but I think that's where the real leadership of this equity market is, and I think that's where it will continue to be.
The reason I ask you that question is because these sectors have done well in India too. Do you see diversification in lieu of a new government to your India exposure? If yes, where is the opportunity that you spot right now?
I think we will get an indication from that from the government itself. As I said earlier today, this election was really all about the importance of industrial renaissance. It was all about a mandate for structural reform, and when the new government identifies and articulates which areas of the economy it's going to focus on with its reform agenda, I think that will indicate to investors where we should look.
Right, Dominic, you have an overweight on banks in your EM portfolio. From a price to book perspective, do banks still look attractive? How do you look at Indian financials at this juncture? How do you compare them against financial names across the region?
The Indian financials are always a two-edged sword, because obviously you've got the state-owned banks, which are always cheap. And they are cheap today, but that's because they have some balance sheet issues. Non-performing loans need to be recognised and written off. Many of the banks, I suspect, will need to be recapitalised, and they're very distinguished then from the non-state banks. And I think, again, one area where we will look to for this government is its attitude towards the state-owned banks, and whether or not it will see a need to deal with those debt issues and its capital requirements.
In your Outlook 2014 note, the report you put out earlier on in the year, you had favoured US equities, Dominic. The view among fund managers at the time was EMs will see a rally in the second half of calendar year 2014. What do you make of the EM versus DM trade at this point?
I still think the momentum and the main story remains with DM. And particularly the United States. I've been very consistent in a bullish outlook for the US stock market, and that isn't going to change. All the indicators that I look at suggest to me that the US economy is in a good a state as I've seen it in the last 30 years. It doesn't mean it's in a perfect state. It just means it's in as good a state as I've seen throughout my career. I see a fiscal surplus on the horizon, remarkably, maybe even as close as 2 years. I see a current account deficit improving, and I see a vibrant corporate sector. So I think the outlook for the US economy continues to be strong, and I think that will carry the stock market forward.
Dominic, growth in the US was worse than expected in Q1. A slow growth revival armed with QE tapering. What does that really mean for the US markets, which haven't done much year to date?
I think it's interesting that obviously we had a weak first quarter in terms of GDP growth for the US economy. We all know the reasons why. That was all weather related, and we've seen a pretty sharp rebound in activity in March and in April, and I suspect we're going to see a very strong second quarter number. I think this means is that the earnings profile for the US economy is going to accelerate. And I think earnings estimates are probably still low for 2014, and therefore the market will continue to make progress.
And finally, Dominic, before we wrap up, how do you compare the earnings cycle? Because that's an important variable that the market is monitoring right now. How do you compare the earnings cycle in the US to that in emerging markets? So far, we've seen companies in DMs and EMs show profit growth by cutting costs. So improvement in margins is being seen in earnings. Sales pickup is yet to happen. The cash generated is not being deployed as investment, and the demand environment is slow. What then will drive markets, and how do you see corporate earnings into the next 3 to 4 quarters?
I think that you're right. In the United States, certainly up until 2013, top line growth wasn't that evident, and what really drove earnings was margins, and margins are at historic highs, and the bears would argue that those historic highs need to revert to the mean. I actually don't think that's going to happen. I think we are now going to see an acceleration in the top line. Nominal growth in the United States, which over the last 3 years has hovered between 3 or 4%, is likely to be closer to 4 or 5%. So I think that nominal growth is going to lead to a slight uptick in sales trends, and also because I did see no organised labour power in the United States, that the prospects for unit labour costs to rise to be really quite low, and therefore I expect operating margins, although at record highs in the United States, I think they will continue to rise, and therefore I think we will see record profits this year and next year on the S&P 500. I think for the emerging market universe, I think the outlook is more mixed for reasons that I've already given. I think emerging market companies are quite used to running their P&Ls and balance sheets with double-digit top-line growth. I think that era is probably over, and I think emerging market companies are going to have to be much more adept at controlling their cost structures, and I think some of them will struggle. So I think the outlook for emerging market earnings is more structurally constrained than those in the developed world, where developed world companies are more accustomed to dealing with low nominal environments than they are within the emerging world.
Dominic, I know this is your first interview to an Indian business channel, so thanks very much for taking out the time to speak with us. We really appreciate your views. With that, we come to the end of this edition of India Decides, the FII View with Meet and Veer Gill. Catch you with another special guest next week. Till then, take care.